Thank you, gentlemen, so much for joining in. I must say that the market volatility is a mere coincidence. When we were thinking about the concept of this show, it was not at all linked to the current market fall. But in general, I think while we pay a lot of attention to what to buy, we don't discuss how to manage our investments and our money. So those are, some of the opening thoughts. And thank you very much for joining us on the show today.
Thank you.
Thank you, Surabhi.
Your thoughts, since we're discussing the current market volatility, how is this patch of a correction and investor behavior in this correction different from maybe what you saw 3-4 years ago?
I think, hi Surabhi, I think firstly, we discussed a few things. I was very intrigued by what Sir was also saying. One, we spoke of the fall.
Yeah.
There are two kinds of falls. Falls which are business as usual, and the second nature of equity. See, 10% fall in the last 24 years of this century has happened every 10 months. Okay, so 10% fall pe surprise hona is surprising to me. Why should somebody be surprised on a 10% correction when that's the second nature of the beast?
Sure.
That's point one. What an investor needs to be worried about is catastrophic falls. 20-25%.
Yeah.
If I put my money and see it down by 8-10%, that was something which was known to me before I invest.
Because that's the nature of equity.
Correct.
Yeah.
If you consider it as an art, it might come as a surprise to you. If you consider it as a science, then you would have seen the data.
You tell us, Feroz, while, of course, I mean, it's a matter of great expertise. Selecting a fund is not a joke. But generally, when investors engage with their advisors or with their distributors, what are the additional factors that they should be aware of, that they should consider and check before taking the investment call?
Yes, there are two parts to this answer. One, I concur with what DP sir said. If you are a viewer and if you're a client or a research, you're an investor who's a retail investor who can't afford all the research or can't afford till some time a private banker who can do the research, looking at the fund house, looking at the fund house's pedigree, looking at the fund manager's stability, looking at how he has managed several funds, how all that information is available in the public domain. The two pieces of Anand Rathi's information, unfortunately not there in the public domain, but you bring it to public domain by shows. We've done so many shows and the output of that is available to all the CNBC TV 18 viewers. One thing which I swear by, two things I swear by, is called the target NAV.
Okay.
If a stock has a target, you see so many reports, TV 18 tweets about this stock.
Stock price target, 12-month forward target.
So is it not logical that if a stock can have a target, a group of stocks, which is wrapped in a mutual fund, can have a target?
Wow.
Right? I was discussing this with somebody and he said, stocks pay every time somebody was giving a stock recommendation. I was sitting as a spectator, another distributor was talking to him. As soon as he said a stock, he asked, what is the target? Then he said a mutual fund, he didn't ask for the target. So that is where it emanated from. So target NAV tells you what potential future is there. Not that it will always transpire, but it's a good hygiene check. That's point one. Point two, we do this analysis where we find out if the fund manager was on holiday, what would be the NAV. So we built some algorithms to figure out if Vasan was on a holiday. Okay, Vasan is the CIO. Would the investors be richer or poorer?
Okay, so that's a great starting point in terms of what all you need to consider beyond just past returns when you want to make that investment decision.
Absolutely concur. And like DP sir said, there are two kinds of investors. One who need the money in the next 3-4 years. Some people have eternal money or 5 years, 10 years from now. So I completely concur on the first category. The second category, which is if I don't need the money, is there some profit booking required? Unfortunately, complex questions, we look for complex answers. It's a complex question, right? Abhi nikalun, kab nikalun, nikalun bhi nahi. But I think the simple answer is rebalancing.
Okay.
Rebalancing is nothing but an automated process of profit booking. If you have decided 70% of your money should be in large cap and 15% in mid cap and small cap, find out whether that equilibrium is disturbed and re-establish the equilibrium. That's rebalancing within mutual funds. Second, if your two asset classes are 80 in equity and 20 in debt, the reason why I'm giving you 80 and 20 as an asset allocation itself implies that 80 should be in equity, if it's long-term money, at least, if not more. Then if 80 has become 90 by the virtue of mark-to-market, then you bring it back to 80. So profit booking has to be substituted with rebalancing for an investor.
So your asset allocation remains in place. Got that. Now, Feroz, here help us out with creating that model portfolio, and maybe also give us some names, because I know that you have a model portfolio and there are a couple of funds there that you really like. So first, tell us, what should the construction be for this medium risk, middle-aged sort of an investor, someone in their late 30s, early 40s, and some fund examples as well, if you can.
Sure. Firstly, I think equity allocation, asset allocation for your long-term money, India is only 6.7% at an household Indian savings level. So if you want to be smarter than the rest of the race, you will have to at least have 70, 80, 90% of your long-term money in equity. I can substantiate it with a lot of data, but I'll not refrain because you gave me 2 minutes. Second, there are some AMCs, we rate AMCs because there are 5-star ratings to schemes.
Yeah.
We have an internal model to rate AMCs.
Okay.
There are 3 5-star rated AMCs.
Okay, 5-star based on what?
That's a very long
That's
story.
a very long answer, but
story.
yeah.
But we have rated.
Okay.
And if you are over concentrated on these 3, don't worry.
Okay.
And let me acknowledge that SBI is one of those.
Sure.
So sometimes people say, yaar, मेरे 80% scheme SBI की है या एक specific AMC की है. If you are in the 5-star AMC, don't worry.
Okay.
If concentration risk is not so much of a risk at all, to my mind.
Okay.
Because like SBI will launch, or these AMCs will launch any NFO at the right time. That's one of the huge barometers. Now coming to what schemes you should look for, I'll give you in different categories. In SBI, if I have to give you one, in the SBI infrastructure, which is a thematic scheme, which viewers love to have something which is a tadka. So SBI infrastructure, very rare thematic scheme. HDFC FlexiCap is a FlexiCap scheme.
Okay.
Canara Robeco Multicap is a little unconventional scheme. And then on the category of small cap, Invesco Small Cap.
Okay. So those are some, funds and broad sort of ideas one can work with. But Feroz, one more point, and we haven't discussed it on the show enough. This whole active and passive. It's not active versus passive. We all get that. And a lot of AMCs have been talking about the satellite and core approach that, active funds should be the bulk of your portfolio. Then you add some passives. If you could elaborate on that, because there's so many, like you said, tadka, so many index-based strategies coming, momentum, quality, this, that, whatnot, leaves you a little confused.
You see, firstly, on that reaction, the answer is different for each of us. Okay, if you have the art of picking active funds, or your distributor does, active is good for you. If he doesn't, and if you're going to forget it for 20 years, then passive is better for you.
Okay.
So that's one.
Okay.
Second, active in most categories is very good. A large cap, if you want to buy a passive, then in the large cap category you can buy. 85% of the total passive AUM of about 7 lakh crores is in Nifty and Sensex. That's the reality. There could be so many tails, such long tail with several schemes, but the AUM is not there.
Sure.
So if you want to buy one passive scheme, then choose the large cap category passive scheme.
Okay.
Third, when you buy a passive scheme, you have to check whether if you did all your transactions for the last 10 years. Today you can get your total statements from MF Central. You can download all the transactions you have ever done in life on an Excel sheet.
Okay.
Download the Nifty data and check whether you're richer or poorer by buying and selling active schemes. Like I do that for the entire company's 39,000 crores of our clients. My clients are richer by 1,923 crores for this financial year by buying and selling, not buying and selling Nifty, but buying and selling those 14 scheme model portfolio.
Okay, all right, got that.